Today I want to talk about diversification. The idea behind diversification is that not all investments perform the same way at the same time. And so if we invest in a variety of investments, then we can prevent the occurrence of an entire portfolio or all of our wealth going down at once. It also might mean that it grows a bit slower, but over the long term, it is safer and an important concept when it comes to portfolio building. So I would say there's two basic ways to think about diversification. You can think about it based on asset class. So the two most common ones are stocks and bonds. And then you have additional ones such as real estate, private equity, private debt, maybe hedge funds. But if we stick to stocks and bonds, you can also diversify within those asset classes. And when you're thinking about doing so, the idea is that you're picking things usually along a risk spectrum. So if we think about bonds, we talked about the two basic risks that face us when we're investing in bonds, and those are interest rate risk and default and credit risk. So when we're investing in bonds, we might invest in a diversified way, picking bonds that have different maturity dates. That will cover different interest rate risks because it's riskier as you go out in time because it's harder to predict what's going to happen to interest rates. Similarly, if you want to diversify your bonds based on credit or default risk, you might choose to invest in higher quality or lower quality bonds. We talked about BBB being investment grade or above and below being high yield or junk bonds. Then if we switch to stocks and we think about diversifying along geography, so we could pick Canada, the US, Europe, emerging markets. These all have different risk profiles. We could also pick different sectors. So there are financials, there are GICS classifications, and companies are put into different categories. So there's consumer staples, consumer discretionary, industrials, technology. And again, these industries have different profiles. Also, we could choose to invest in companies based on market cap or size, right? Larger, more blue chip companies being safer, and smaller companies maybe having higher growth potential, but being slightly riskier. But the really important thing is to choose a variety because that is what gives you diversification and increases the safety of your portfolio. Now, it's commonly thought that 25 to 30 stocks is the optimal level for diversification, and anything beyond that really presents minimal additional benefit. You don't want to over-diversify because then your portfolio won't even move because you'll have so many things having different growth or loss, then it will be hard to see a trajectory of growth. And finally, there are products that are pre-diversified. So if you invest in a fund or in an ETF, which already holds a bunch of companies, then that is already diversified. Please let me know if you have questions.